But let's welcome on board Shyam Srinivasan, MD and CEO at Federal Bank. He joins us on the show right now. Shyam, hi, good morning. Good to have you on the
Morning.
show. Meeting you after quite some time. How are things?
All is good. I
Very
heard
well.
your laugh. Yes, please go ahead.
Great. I want to talk, Shyam, firstly about credit growth, and that seems to be somewhat improving in the system. Are these two led by inflation or preference in shift from bond to banking credit now?
I think the answer is partly in the question, both and other factors. I think it's been the capacity utilization probably is at a level which is inspiring people to go out and do more and sort of investments that requires credit. Then the inflationary impact. Then the fact that other instruments that were earlier a lot cheaper have come back. And lastly, the bank's credit appetite is also now much richer. So I think a combination of factors we've seen now for a period more than 10% credit growth. I think from here it should be picking up, and we are seeing signs of it already.
Let me talk about Federal Bank now. In terms of growth, how is it that you see the bank and other large private banks, for instance, they've been able to grow by 14 to 20%, whereas Federal on a smaller base has grown 10%. How fast than the industry can the bank grow going forward?
It's never a race to grow faster than somebody else. It's a race to grow good credit. And I heard in the earlier interview, you talk about a long 10-year period. Over a 10-year period or any slice of time which is longer, we've grown quite materially and much higher than the industry.
Shyam, it's not a race, but it's flattering indeed. You have to confess.
Okay. So our choice is very clear. We will grow when the appetite is there and the credit quality in the market is in a good place, because I don't want to be growing at some record speed and then facing a credit challenge not long after. So that's why I said if you take any long slice of time, we've grown materially better than the industry, but our credit standards have been way, way better than everybody else. And today, if we grew 10% last year, but I'm saying, guiding for a much higher growth in this year, because we did see in certain pockets post-COVID, there was some stress, and we did not want to accelerate into that. As we see things emerging much clearer and looking better, we are confident of picking up on that. So I think this year we will see much higher rate of growth. And 1.5 years during COVID, we saw slower growth by choice. So I'm quite sort of optimistic about the growth opportunities. We haven't lost steam. Neither have we sort of gathered any bad credits along the way. So I think we are in a good position to grow, remain well capitalized. So I think we are in a good place.
Good morning, Shan. This is Nantar joining the conversation. In a recent interview to a newspaper, you had said Federal Bank is factoring in a repo rate going up a lot more for the next 12 months, and you are working your plans around that. Can you share with us, when you say you're working your plans and products around that, what exactly you mean and what's in the offing?
I think at that point in time when we made that statement, the most recent policy announcement had not happened. But that said, I think there's still view that interest rates may go up. So I've always said that the credit standards, credit quality is paramount. But we are in a place where some businesses we had tightened quite materially during COVID. For example, our retail unsecured, which had just given birth, our credit cards and personal loan business, just before the pandemic, we slowed down quite materially. As things have come back, we believe that's a good growth opportunity. And these typically are price agnostic kind of products. So there's an opportunity to grow that. Businesses like commercial vehicles and commercial equipment, which we had started, but again scaled down, or demand was much lower, we had cooled off, that's beginning to come back. Corporate, I did mention in the earlier question of Aisha, was that these are businesses that saw other lines of, other ways to get credit, and now they're coming back to the banks. So credit growth along all these lines are positioned for growth, and interest rate increase has some bearing, but equally the inflation and other aspects are demanding more credit from the banks. So I'm happy that we are positioned for all this to keep growing in this quarter or this year.
Shyam, in the 90s, we had Bill Gates making a prophecy that the world needs banking, maybe not banks. In the last 2 years, so much was being said about fintech. But fintech didn't turn out to be the kind of threat to banks as had been envisaged. And banks, like Federal Bank, also stepped up the game when it came to fintech. You have what, nine Fedi studios, as you call it, which is meant for digital banking. You have made relationships with business correspondents, with fintech startups as well. Going forward, digital lending, which the RBI will also be coming out with a policy for, how big is it going to be for Federal Bank?
No, our view on this, Nantara, has been for the last 2+ years. We've been very big on fintech, as you pointed out, and I continue to be quite bullish about that. But it's never been about because they will take away business from us. We've always said it's a collaborative story. That's why we are the first bank to go with two neobanks, with the FPL on the credit card side, and many other partners. But we see that for us as a large distribution opportunity. And for the fintech partners, it gives them the banking platform. So it's quite, for want of a better word, symbiotic at this point in time. I think this relationship model that we've chosen is working well. Now, should they ever sort of grow wings and become completely independent institutions of their own, that could happen well into the future. But all pointers of the communications that come from regulators suggest that they're quite comfortable with a partnership distribution kind of model. One has technology skills as a banking skill. So I think that combination is where I visualize this playing out. I am not nervous that they will all become competitors by themselves, which is why we've gone headlong into this whole fintech journey. And I'm seeing that gain traction almost every passing week, I would say.
Shyam, what the market also wants to know is what's happening with succession planning and any changes at the mid-level management.
I still have a long time to go unless something you know or somebody else knows. But we bat very deep. Our team is very good. We have people at all levels. In fact, just 2 days ago, the board and the Nomcom reviewed our entire succession across levels of the organization. So I think we are in a good place. We don't see any stress around that. And, this job is something that will be coveted by many. So I'm not nervous about that.
Of course you aren't. Tell me, what about overall asset quality? Because your performance has been good, your credit cost is low throughout the cycle. You've managed to, clock about 1% ROAs in intermittent quarters as well. What about your thoughts on, say, increasing NIMs going forward? And which products do you think would actually help and aid this growth?
I think the ROA is now at around 1%. We've been guiding for 10-15% improvement each passing year. And that's going to be driven by both margin expansion, by some of the products I mentioned, credit cards, personal loans, commercial vehicles, microfinance, gold, all are picking up and growing quite nicely. So as margin expansion happens, you're seeing it flow through to the NIM, to the ROA. So I think our belief is that products like this, which we've put slightly on the back burner during COVID, with our very robust credit standards and credit quality, I believe these are opportunities for growth. And we've, giving it a lot of impetus as we go into FY23 and beyond. And we're already seeing that, by our own organic credit card distribution and our partner-led credit card distribution. That's gathering steam. If you see the industry records, you will see our rate of growth are, of course, albeit on a very, very, very small base, are at almost 3-digit kind of growth rate. Personal loans, again, we had sort of slowed down. That's beginning to grow quite well. Commercial vehicles trending quite well. So these are businesses that we've understood, we've capacitized, are relatively higher yield. And within the risk appetite we have, I expect these to be businesses that will step up and give us the margin expansion. In addition, our CASA continues to be very strong and robust and growing. So I think the combination of this, also rising rates typically tend to be margin positive. So we will see margin expansion, we'll see credit growth, and hopefully it will flow through into ROA expansion.
Shyam, always great having you on the show. Thank you so much for taking the time out for us.
Thank you. Welcome.